You ever look at gold lately and think something feels off? There's war, there's financial stress, people keep talking about instability, and yet gold is falling. That doesn't make sense, right? Because normally, in times like this, gold should be going up. So what's really happening? Today, I'm going to break it down for you in the simplest way possible, because what you're seeing right now isn't random, it's structure. Let's start with one key idea: credit tightening. Sounds complicated, but it's not. It just means money stops flowing. Banks lend less, companies can't borrow, investments slow down. And if it gets bad enough, the entire economy starts to freeze. We've seen this before. Back in 2008, banks collapsed, markets froze, stocks crashed, real estate collapsed. And here's the important part: everything dropped at the same time, even assets people thought were safe. So where are we now? We're not in a full credit crisis yet, but the early signals, they're already here. Interest rates are still high. Borrowing money is expensive. Banks are tightening lending standards. Loans that used to get approved now get rejected. Companies are paying more just to survive debt. And there's growing stress in commercial real estate, especially office buildings sitting empty across the US. Put all of this together, and you're looking at the early stage of credit tightening. Now here's the big question: if risk is rising, why isn't gold going up? Because markets move in two stages. This is the part most people miss. Stage 1, the shock. When fear first hits, everything drops. Stocks fall, real estate falls, and yes, even gold falls. Why? Because people need cash. When losses start piling up, investors don't think about safe assets, they think about survival. They sell what they can sell, and gold is one of the easiest assets to liquidate. So even though it's a safe haven, in the beginning, it gets sold too. Stage 2, the shift. This is when things change. Fear spreads, the financial system starts to wobble, and people begin asking, where is my money actually safe? That's when gold comes back. At the same time, central banks step in. They cut rates, they inject liquidity, they try to stabilize the system. And when that happens, gold doesn't just rise, it surges. So where are we right now? We're likely still in stage 1, early stage. Rates are high, the dollar is strong, liquidity is tight. That combination, it creates pressure on gold. That's why it feels unstable, not clearly up, not clearly down. So what should you do? This is where most people get it wrong. They panic and go all in on gold too early. But timing matters more than direction. Right now is not the time to go all in. Instead, you scale in, you keep some cash, you hold some dollars, and you build your gold position gradually. Then, when the real crisis signals hit, that's when you increase exposure. Let me leave you with this: credit tightening is ultimately bullish for gold, but in the beginning, gold falls with everything else. If you understand this, you stop reacting emotionally and you start seeing the structure. Because this moment isn't just risk, it's the beginning of opportunity.